October 13, 2020 in Pacific time at the moment. Today's episode, 1099 side gig, individual or solo 401k, and mega backdoor Roth calculator. This is the 39.6 Facebook and YouTube Live Finance Show. This is the show that teaches high earners like yourselves how to make your money work for you, so you don't have to work for your money. We talk general investing, taxes, real estate, Airbnb, syndications, paying for college, paying for childcare, and even the car you drive. Today, we are going to address this mega backdoor Roth topic, how much I can put into my solo 401k for my side gig, and how much ultimately I can do mega backdoor Roth. All right, I've had a lot of questions about mega backdoor Roth and like the EQRP after PIM and Decon. So I actually discussed mega backdoor Roth a little bit back in episode number 2. This is like 2 years ago. This is like not an episode 2 type of a topic, but I did an episode 2. Please feel free to review that. It talks about the way that the gains versus the contributions are dealt with from a tax perspective. We are not going to focus on that today. I'm sorry, the gains and the contributions of the non-Roth after-tax contributions. We won't discuss that today. We're going to focus on how much I can put into my solo 401k as an employer and ultimately how much I can do as a mega backdoor. Now, this should not at all be confused with a backdoor Roth IRA, which is simply a non-deductible traditional IRA contribution followed by a Roth conversion of that traditional IRA money. We are not even going to talk about IRAs right now until a little bit later for a little bit, but this has no bearing on that. Okay, nothing. These are completely independent things. So do not think of a backdoor Roth IRA as an account. First of all, the accounts are traditional and Roth IRA. And do not think of a mega backdoor Roth IRA as an account. It is not an account. It is just a nickname for a process. Okay, the account would be like a 401k or a solo 401k or maybe a Roth IRA, but there is no such thing as a mega backdoor Roth IRA account. Okay, so common scenario, which is what we're going to address here, is you have W-2 wages from your primary job, and you are earning at least $137,700 at that job, which means that you are filling up the entire Social Security wage base. So you cap out on Social Security contributions as an employee. That's about like $9,000. Now, after that, you stop paying Social Security. Therefore, when you earn additional income at a second job, whether it's W-2 or if it is 1099, you will not have to pay any additional Social Security dollars for your income. Now, if you have a W-2 job, yeah, they're going to withhold Social Security, but you're going to get it back when you file your taxes. So you're really not paying for it. Medicare, however, has no limit. That just keeps on going. So on your side gig, you are going to have to continue to pay Medicare tax, not Social Security. And this is important because this goes into the calculation of how much of your 1099 income can be utilized to calculate how much 401k contribution you can put in to the solo or individual 401k that you create for your side business side gig. Okay, so I have a calculator here which has 2 columns. We have the W-2 column on the left and the 1099 column on the right. I'm going to first make this bigger because sometimes when I do this, it doesn't actually go back and switch back. Okay, so I'm hoping this is showing up. Sorry. There we go. Okay. So on the 401k side, I have a box for W-2 wages. This is just to make sure that you're over 137,700. You can put any number in here. It won't have any bearing. But here I have $200,000. Then you fill in the boxes that have squares around it, the cells that have squares. So you only have to fill in 2, 3, 4 cells. So the first cell here is how much you're putting in as an employee as a pre-tax contribution. So most people will fill up $19,500 into this box. Okay. Now, if you are going to do a Roth contribution to your 401k, you could put it into this box. But if you're high income, top tax bracket, or anywhere 30% or higher, you're going to want to likely pursue pre-tax. So I put it all here in pre-tax $19,500. Okay. Then there will be an employer contribution, which will be like the safe harbor match and profit sharing. And in this situation, I put in $37,500, assuming that this employer gives you the full total possible amount they can, which will get you to the full $57,000 limit, okay, per year. This is for people who are under age 50. If you are 50 or higher, this would actually be $63,000 because you can get $25,500 as an employee. Okay, but you can disregard that in this calculator if you're under 50, and this calculator really is designed for under 50. Okay, so that's simple. Then you have your 1099 job, and I'm going to put in $100,000 here of income, which is the first box. I use 100,000 because then all the numbers are going to be percentages. It makes it easy for people to understand what percentage they can contribute. But you start out with $100,000 of income, and in this example, we have no expenses. Okay, so you can have expenses for your 1099 job. And if you have expenses, that will reduce the amount of taxable income, but it will also decrease the amount you can put into a 401k. Okay. Now, if you're at a high tax bracket, it still makes sense in general to take any deductions you can from your business because that will save you at your marginal tax rate, paying any tax, even though it will decrease your pre-tax retirement contributions a little bit. Now, after that, we have your profits, which is income minus expenses. Because there's no expenses, we have a total 1099 profit of $100,000. Okay, or Schedule C profit. That's where it would go on your tax return. Now, again, this is for sole proprietors as a side gig, not people who are filing as an S Corp on a side gig. Most people should not be filing as an S Corp for a side gig. It makes sense for a primary job, but not necessarily for a second job because you have to pay Social Security all over again. So this is strictly for sole proprietors. So $100,000 of profits. Then you have to deduct half of self-employment tax, which is not subject to tax at the federal level because that's the employer side. It's really complicated. But this ends up being $1,339. Ends up being 1.34% of the 1099 profit. Okay. If there were Social Security being paid here, it would be a lot higher. But because it's only Medicare, it's very low. So your net income minus half of self-employment tax is $98,661. That is the amount that matters for calculating your 401k contribution from the employer side of your 1099 business. So in your individual 401k or a solo 401k, on this calculator, I assume that you are not putting any money in to the employee side of the 401k because you've already filled up $19,500 in the W-2 job 401k. So the entire amount that is going to go in pre-tax here is going to be the amount the employer can contribute. And the employer can contribute 20% of that net income minus half of self-employment tax. So this $98,661, which I mentioned just a second ago, divide that by 5 or multiply by 20%, and it gives you $19,732. Okay, so that is the amount that you can put into an individual 401k as a sole proprietor earning $100,000. You could also put that money into a SEP IRA, but we're talking about mega backdoor Roth here. So you can't do a mega backdoor Roth with a SEP IRA. You can do a mega backdoor Roth with an individual 401k. Okay, and so we're going to be using an individual 401k, and you're taking that 20% of net income minus half of self-employment tax. I used $100,000 because this shows clearly that that percentage would really be 19.73% of your 1099 income. That is assuming you have no 1099 expenses. So people tell me, well, I earned X amount of dollars at my 1099. How much can I put into my 401k for my side gig? Well, first question really is, do you have any business expenses? They may say no. Okay. Did you fill up your 401k contribution at your primary job? Yes. Okay. Well, that situation, which is what we have here, you can only put in an employer contribution, and it would be 19.73% of your 1099 income. So there you go. It's not quite 20%. It's just a little bit less. Then, in any 401k, the maximum contribution is $57,000. Now, if you only earned $20,000 at your 1099 job, you can't get to $57,000. You need to actually have the income there to support this contribution. But we made $100,000 here, and $19,732 of it went into the 401k already, and there's a little bit that went to Social Security or to Medicare, but most of the money is not yet accounted for. So there's still a lot more money we can put in to the individual 401k as what is called a non-Roth after-tax contribution. Okay, so this is actually going to come from the employee side. That's not that important here because it's a sole proprietor, but and just for technicalities, the only amount that an employer puts in is always pre-tax. An employer cannot put in post-tax money. Only employees can. So this $37,268 that's listed here would be subject to federal taxation, but that is the amount that you can put in. It's a lot. It's like twice as much in this example as the employer was allowed to put in. That $37,268 is after-tax dollars. Okay, and this is in my episode 2, I talked about the 3 flavors. You have pre-tax, Roth, and non-Roth after-tax. Pre-tax is great. It goes in, you get tax deduction, it comes out, you pay tax. That's my favorite. Roth, second best. Roth goes in after tax, but at least all of the gains, when you pull them out, are not taxed. A non-Roth after tax, it goes in after tax, and when it's in there, it doesn't charge you tax, but when you pull it out, you do pay tax on your earnings. Okay, I talked about this more in episode 2. But, yes, talking about taxes makes me tired as well. It's funny, it's like 1:30 in the morning over here, and I'm doing a talk, and I have to be at work in a handful of hours. But right now, I'm on like the toddler shift, so I'm putting the toddler to bed, and I fall asleep for like multiple hours, and then I get back up, and then I do, and then I go back to sleep. It's really complicated. But so you get $37,000 in. The reason why it's 37 is because it is up to $57,000 you can get into the account. And that is into each 401k, the 401k from your job and the individual 401k from the side gig. That's a total of $114,000. But you do not want to leave money in there as non-Roth after tax. That non-Roth after tax has to get moved into a happy place. You can't move it into pre-tax, but you can move it into Roth. So this would be, Roth would mean that the gains would not be subject to tax when you draw it out. Okay, so that $57,000 has to get put into a Roth bucket. So option 1, you would do an in-service Roth conversion within your individual 401k. Now, most 401ks do not allow this. Okay, and a lot of 401ks don't even allow non-Roth after-tax contributions. But you need to have non-Roth after-tax contributions. That's a prerequisite. And then you need to have a way to get it into a Roth bucket. So an in-service Roth conversion, this is the simplest way to do it. There are companies, I believe my solo 401k does this. I have no affiliation. I just heard about it. But they basically just create the plan documents for you, and then you open up the account somewhere. It's not very expensive to do it, but it's not like an off-the-shelf easy thing to just plug and play, like opening up a Roth IRA account. So you have the account open, you make your contribution to the pre-tax and the non-Roth after-tax. Then, as soon as the contribution is made, like a day later, once the money is posted, then you do an in-service Roth conversion, which takes that non-Roth after-tax money, $37,268, and it converts it into the Roth bucket within the solo 401k. So you still have the exact same amount of money in there. You still have $19,732 inside as pre-tax dollars from the employer, but that $37,268 got moved from that fourth bucket, non-Roth after tax, and it moved it over to that second bucket, Roth. Okay, that's it. So now you have $37,000 in Roth. And people say, well, why would I want to put in Roth money? I'd rather put in pre-tax money. You don't have a choice here. You've already filled up all your pre-tax money. So your question is, if you're going to put it in over here, non-Roth after tax converted to Roth, mega backdoor, or put it in directly into a regular taxable brokerage, a taxable account. This is the same argument for whether or not you should do a backdoor IRA. You can't put any more pre-tax dollars. So you're stuck with either Roth or taxable. And a lot of people will argue that Roth is better than taxable. There's a very good reason to say that, because over time, taxable will have to pay taxes on dividends, interest, capital gains, and Roth you do not. On the other hand, Roth, you do not get to do tax loss harvesting. Okay, so regardless, if you want to stuff a bunch more money into a Roth bucket, this is a fantastic way to do it. It's $37,000. This is way more valuable than doing a backdoor Roth IRA, which is $6,000. It's really not going to move the needle much for very high earners. Okay, now, option 2, if you don't have in-service Roth conversions, or if they allow you to do what's called in-service distributions, where you can roll your money out of the 401k. Well, if you can roll out the non-Roth after-tax portion, you roll it out, you take a distribution, and then you move it over to your IRA, your individual retirement account. So the same IRA that you do a backdoor IRA, backdoor Roth IRA, the same Roth IRA, okay? You put your non-Roth after tax, you roll it into there, and boom, you're done. Your individual 401k still has the pre-tax amount of $19,732, and it no longer has any non-Roth after tax. It got moved over to a Roth IRA outside. Now, if it does allow in-service distributions, you can potentially even roll the $19,732 out and put it into a pre-tax traditional IRA. You could do that and completely empty out your individual 401k every year. However, if you have pre-tax money in a traditional IRA, then you can't do the backdoor Roth IRA, not the mega backdoor Roth IRA. Okay, so you have to do one of these two things. You have to do an in-service Roth conversion within the individual 401k, or you have to roll it out and put it into a Roth IRA. If you can't do one of those two things, then those gains are going to gain in there, and when you pull it out, it'll be taxed as ordinary income at your marginal tax rate. If it's not in there for a long time, it could be fine. But if it's in there for a long, long time, then a taxable account can be much more preferred. Now, there is one big caveat to this. Okay, so this is two 401ks, and the combined total here is $114,000. If you have a 403b at your primary job, okay, and I'm going through this all because these are like the exact questions that a number of people have been asking me for the past week. A 403b, unfortunately, caps out $57,000 across both of these accounts, across both your 403b and your individual 401k. All of them. So in this example, we're still putting in $19,500 into the 403b pre-tax. And now the employer is just going to do, let's say, a 4% match, $200,000, 4% match is $8,000. It could be higher, but 4% is like the safe harbor match. So that ends up being a total of $27,500. In the 1099 job, you're still going to get $19,732, 19.73% into the pre-tax portion of the employer contribution. Sorry, not the pre-tax portion, but the employer pre-tax contribution. Okay. You've already filled up the 19.5 on the employee side at your W-2 job. So again, there's no pre-tax or Roth contributions as an employee. So from that $19,732, you're using up more of that $57,000 limit. We got $27,500 at the main job, and then $19,732 at the side gig. That ends up being about $47,000. So you have about $10,000 of more space that goes in as non-Roth after tax. That $10,000, which is $9,768 in this example, but $10,000, you can then again do either an in-service Roth conversion where it ends up being in the Roth bucket, or you could do an in-service distribution to a Roth IRA. And there you go, $9,768 into a Roth IRA. There you have it. There's your calculator. I'm going to upload this over to the Facebook community so you guys can download it. Has not been super rigorously beta tested, but use it to your own risk, at your own risk. But I think this is pretty helpful because I don't know if this calculator is really out there for y'all. At least I haven't seen one, and it's super useful, and this will help decrease a lot of questions. Okay. Again, this is for my entertainment, maybe yours. This is not legal, financial, accounting, or other advice. Please consult your legal, financial, any other professionals before making your own decisions regarding your finances or anything else to that matter. That's it for episode number 100. Until episode 101 tomorrow or today. Oh, yeah, today I got to vote. Early voting in Texas. Get out there, get your vote in. Only like 3 more weeks. All right. Have a good night.